What's up guys, Enjoy here. Welcome to my channel Texo Academy. If you are new here, thank you so much for stopping by to check out our videos. In this channel we make videos on all things make money online, entrepreneurship, digital marketing, cryptocurrency and the likes. So if any of this interests you, please do well to smash that subscribe button and don't forget to like each and every video we post on this channel, and do well to share with your friends and family. All right, so and if you are a returning subscriber, you are the real VIP. So in today's video we are going to be discussing a very important topic. So many of you have registered on an exchange and you are wondering what those buttons are for. So we are going to simplify this process for you by differentiating and explaining in depthly on what market order is and what a limit order is. So I'm going to be explaining that right in this video. Okay, so let's quickly dive into what we have for today. Okay, so we are going to be talking about understanding the different order types. All right, so when you are trading stocks or cryptocurrency, you interact with the market by placing orders. So what then are orders? Orders simply refers to a series of commands you give to an exchange to either buy or to sell an asset for you. So those commands, those instructions that you give to an exchange to carry out on your behalf, they are known as what? Orders. Either to buy a cryptocurrency or a coin or a token, or to sell. Okay, they are known as orders. Now in this video we are going to simplify these two types of orders that we have. All right, and we have limit order and market order. Now what then is a market order? A market order simply refers to orders that you would expect to execute immediately. Okay, those orders that you expect to execute immediately. What are we trying to say? A market order is just an instruction that you give to an exchange to either buy or to sell for you immediately at the current market price. Please do note that. Okay, now you are giving an exchange an instruction to buy or sell for you at the current market price. So let's take for instance Bitcoin is at $19,000. all right, and you just enter the exchange and you want to buy 3 Bitcoin. Okay, now you are telling the exchange that you want to buy at that 19,000 price. Okay, current market price. Okay, so that's what a market order is. So when you place a trade to either buy or sell, immediately you are not creating a new order. Please note that you are not creating a new order, rather you are filling up an existing order that makes you what? A market taker. Let me explain this. Okay, now when you place an order to either buy or sell, okay, you are not placing a new order, rather you are filling up an existing one. When we talk about the limit order, you are going to understand this better. Okay, and by so doing you are a market taker. In a few minutes from now we are going to explain who a market taker is and who a market maker is, and we are going to see the differences and the advantages, the benefits that it's used to you. All right, now what then is a limit order? A limit order is just an instruction to wait until the price hits a limit or better price before being executed. Now in this case, now you are exercising patience. Okay, you are waiting for the price to get to a certain level before the exchange will execute your instruction. Okay, unlike the market order where you tell the exchange do this now and it does that. Okay, in terms of limit order, you are telling the exchange to be patient with you so that the price will get to a certain level before it will execute it for you. Either for the price to fall below to a certain level before it can be able to buy for you, or for the price to rise above some certain level before it can do what? Sell for you. Okay, so these are orders that don't execute immediately. So that's the difference, guys. It doesn't execute immediately, unlike the market order. Okay, so when a limit order is placed, it enters what we know as what we call order books. All right, now until the price of the said asset hits the price of the limit order, until it gets to that point where you want it to execute, before the market can decide to what, buy at that current price for you. Okay, that's until it gets to that point before the transaction can be what, executed. All right, so now traders who place limit orders on exchanges are called what, a market maker. Now, who is a market maker? A market maker is someone who places what, a limit order on exchanges. Now, market taker simply refers to traders who take out liquidity from an exchange, and as such they pay higher fees. Now we are trying to differentiate between market makers and market takers, and I said market takers are the people or traders who take out liquidity from an exchange, and as such they pay what, higher fees. Now you are a market taker when you place a market order. All right, when you place a market order, that's when you place an order or give the exchange an instruction to execute immediately. That means you are what, a market taker, because you are taking out the liquidity from the exchange. You are canceling some open orders in the order book. So you are taking out liquidity from the exchange, and that's what you are being called what, a market taker. And as such you pay a certain fees which are higher than the ones that are being paid by the market makers. Now let's quickly look at who a market maker is. Now a market maker enjoys lower trading fees unlike the market takers. All right, why do they enjoy a lower trading fees? Because they add to the liquidity of the exchange. They add to the benefit of the exchange. All right, so they enjoy lower trading fees unlike those who take out liquidity from the exchange. Now what do you need to know about market orders? The basic kinds of market orders are just the what, the buy and the sell ones. Okay, the buy and the sell ones. These are the two instructions that you can give to an exchange to execute for you, either based on the market order or based on the limit order. Okay, now you instruct the exchange to make a transaction at the best available price. Please do note this, that the best available price isn't always the current value displayed. The best available price is not always that value, that price that you see that is being displayed. Okay, it all depends on the order book. So you could end up executing your trade at a slightly different rate. That's why most times when you try to sell your coin, probably the coin is shooting up and you want to catch the top. Okay, and you place a market order to quickly sell for you, and somehow the price has depreciated a little bit, or it has come down a little bit, or it has shoot up a little bit. So you discover that if you were expecting $100 to enter your sports wallet, you discover that you either have $99.9 dollars, or you either have 102 or 101 point something dollars. Okay, that's to show you the fluctuation in the market. So that's what we are trying to say, that the best available price is not always the current value displayed. Okay, now market orders are good for instant transactions. They are good for instant transaction when you need it sharp. Okay, so you make use of market orders when you need it sharp. But when you've got all the time in the world, you can go ahead to place a limit order. All right, now fees incurred from slippage and the exchange mean that the same trade would have been cheaper if done with a limit order. Now you might be wondering, why am I paying higher fees by executing my transaction immediately? Now it's trying to tell you that you can trade that same trade can be placed on limit order and you will still gain the same value. All right, all you just need to do is to wait out for it. Okay, so that's why you're paying a fee for it. So you need it sharp. So for you to be on the front, you have to pay your way through. Okay, Now, what are the common types of orders? Now, if you love the values that we share in this channel, please do well to smash that like button. I will appreciate it so much. And don't forget to hit that subscribe button and turn on that bell notification, so you'll be notified whenever we post amazing videos just like this one. Okay, and don't forget to share this video with your friends and family. All right, so what are the common types of orders that we have? Okay, now we have the stop limit orders, we have the OCO. Okay, the one cancels the order. Okay, now what is stop limit order? Now, stop limit orders are good tools for limiting the losses you incur in a trade. This helps you to limit the losses that you incur in a particular trade. Okay, so this type of order allows you to set a stop price and a limit price. But what then is OCO? Now, an OCO is a sophisticated tool that allows you to combine two conditional orders. Now, what this does is that as soon as one is triggered, the other one is cancelled automatically. So if you want to learn more about stop limit orders and OCOs, kindly go over to our cryptocurrency playlist on this channel to watch and learn more about OCO, that's one cancels the order, and stop limit orders. We made a very good videos about this, so you can go and watch those videos to learn more about OCO and stop limit orders. Now you can check out the cryptocurrency playlist on this channel to learn more about all of this. So that's it, guys. If you love the value we share in this video, kindly smash that like button, and don't forget, if you got any question, please do well to pen it down in the comment section just below this video, and I'll be right here to attend to them all. So thank you for watching, and see you next time.